Hi, I'm Steven Van Metre, and welcome to your Wednesday Night Live, where every Monday and Wednesday we take 15 minutes to break down what's going on in the stock market, economy, or anything interesting, such as today's FOMC meeting, where Fed Chair Powell came out and announced changes to monetary policy going forward, which surprised everybody. Before we get into that, I want to give you a quick update on how my wife's doing. She's been making, nice small incremental improvements every day. So every day things get a little bit better. Bad things, to just extra pain or just, things that happen during recovery, setbacks as we kind of like to refer them to. While they do happen, she's recovering from them more quickly than she was last week. So that's good news. And then yesterday we went down to the hospital and they pulled all the stitches out of her back that where they cut her from just below her shoulder blades all the way down to, where things naturally split, if you catch my drift. And that was a big help. On the drive down, she, pretty much had to be in a laying position, even though our car wasn't really wide enough for her to lay down. But on the way back, she was able to sit up, and we got some news that she could finally put some heat on her back muscles. It's kind of interesting when you really understand, she is about 2 inches taller, even though it's unofficial. She hasn't been measured yet. But internally, you have to think about your muscles, right? They get cramped into a certain position, and all of a sudden, in an 8.5-hour period, they got yanked. Now the rest of her organs are like, woo, look at all this space. We got some room to move around. But the muscles, anyone who's pulled that muscle, God, it's not fun. So we were concerned about putting heat in places we shouldn't, and so we didn't. And so they gave us some approval, and I know she immediately started putting some heat on one particular tight muscle, and that's helping a bunch. So they also said if you don't need to use your walker, you don't have to. Although they did encourage her to say, use it, when you feel you need it, don't just completely abandon it. So it's cool. She's kind of walking around a little bit without that. So again, every day, a little bit more progress. And now she'll tell you, progress is her middle name. All right, let's get back to the Fed fact. Let's just get the disclosure out of the way here. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell any security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, my own personal capacity. Opinions expressed in this video that I'm going to do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. All right, let's talk the Fed. And I was wrong. And not only I was wrong, nobody saw this coming. So let me tell you what they did. So the Fed's projections, they call the dot plot, which is where every member of the FOMC board or Federal Open Market Committee says, this is what I think, when and where we're going to raise interest rates. It really is pretty meaningless, but it's something people get interested in. Anyways, they dropped their projections for rate hikes to 0, goose egg, for 2019. It was at one point, I think 2, maybe just 1, but anyways, it's now 0. And next year, based on no changes, they only expect 1. And at one point, it was like 4. So that's a big change. But here's the big move that I am just shocked the Fed is doing. And they're going to stop their balance sheet unwind, not in December like Wall Street thought, not next year like I thought, but in September. Yeah, that's crazy, right? So here's what they had to say. They're going to start tapering the balance sheet unwind beginning in May. So that's coming up pretty quick. Let's see. They're going to reduce their cap of Treasury holdings from $30 billion to $15. So they're just going to cut what they're doing with U.S. Treasury bonds in half. At the end of September, cut the whole thing. They're done. Done. I know, it's crazy, right? I mean, who would have thought the Fed would go from great economy to, tap out. Hey, I give, don't hurt me. They caved fast. Remember, in December, they hiked rates and said, look, everything's great. In fact, Powell said today, we think the economy's great. Then why, if it's so great, why are you doing this? Well, that's a good question, because he says now the interest rates, in their opinion, are what's called at the neutral rate. And neutral rate is, not too hot, not too cold. I mean, it's not expansionary, meaning it's not accommodative. It's not too tight. And so the market reaction to this was inflationary, and that is not true either. So let me give you an example. So let's say I was going to go down and buy a car, right? And let's say my credit maybe is mediocre, or who knows, or I had a budget I could afford, like, let's just say it's $500 a month, and I go down and I find the car I want, all the options, whatever, and I go in and I run numbers and I pull financing, and the payment comes to $525 a month. Well, I can't afford it. Remember, my budget was $5. And they said, well, you know, sir, this is a great, yeah, look, I can't afford it. $5, my number. You're at $525 or whatever it is. I got to walk. Well, guess what? It didn't change today. It's not like, oh, hey, the Fed's not going to keep raising rates, so your interest rate on that car is going to drop. No, it's going to stay the same. I still can't afford it. This is going to be the same issue with homes and even credit cards. So if we look at, you know, credit cards are very sensitive to short-term interest rates. And as the Fed hikes, well, so do credit card minimum payments. It just means they're not going up anymore. It just means the interest rates that we're seeing right now, and hopefully that's not my car alarm going on in the background because we're in the middle of recording this. Anyway, it just means things are going to stay exactly where they're at. And that is pretty interesting. So the Fed is saying we're pretty much at a neutral rate. The market's thinking this is inflationary. It's not really inflationary. Again, people that can't afford to buy a home because of financing or cars, TVs, whatever it is, because interest rates are too high, they still are. That is not changing. What it tells us, though, is the Fed's really concerned. It's possible the Fed has gone too far, and they normally do. Global growth is slowing, and they just don't know what to do about it. And so all they can do is just say, well, we'll just take a time out. We'll pause for a while, and we'll see what happens. So let me give you a good example of what I think the Fed's really doing. Is they knew the first quarter was going to be a soft patch. You know, you like that term, soft patch? No, it's not good because the first quarter, we're going to see some bad earnings reports coming out over the next several weeks. Earnings will run through roughly mid-April, but most of them will be out in the next couple of weeks. They know. How do they know? They pick up the phone, they call the CEOs. They have all these people on speed dial. They can find out exactly what's going on about anything at any given time. They know the first quarter is not going to be good. They said that in January. They think things are going to get better in the second quarter. But they're not here yet. So here's my perfect example of how the Fed's approaching this. And this is kind of what happened yesterday when I took my wife down to the hospital. Is there's a part where we go through the parking garage, and she had her walker, and you get to this very narrow walkway. Now, two people could kind of like squeeze through there. It's just not a lot of room, maybe. But with a walker, you can't walk side by side. So what I did is because I can obviously walk faster, is I would go ahead. She said, hey, slow down. I said, well, I'm just going to go up here and I'm going to stop and wait. And I did. I walked a little bit ahead, stopped. When she caught up, I went forward some more. She caught up. And then finally it opened into the building where we could, walk together. That's what the Fed's doing. They think they just got a little too ahead of things. And so now they want to look back and say, okay, economy, come on. We know you're coming. Get caught up. That's what they're really doing. So the notion, that all of a sudden stocks are going to go to, I heard S&P is going to go to 3,000, 4,000. No, look, that's not how it works. In order for the market to go up, the Fed would have to massively ease. And even then, there's a point where they can't do that anymore. I mean, there's a point where it just doesn't work. So all that to say, what's really interesting is we saw the market kind of went down in early trading, went up after the announcement. Yay, Fed's, easy. Oh, wait, maybe they're not really easing. They're just not doing anything. Ooh, back down. But what happened in the interest rate market surprised me because monetary tightening is bearish for interest rates, meaning interest rates should fall when the Fed tightens. And so the Fed said we're going to ease. Now, these computer programs that are reading the news, they don't get that. It's really interesting. They just don't understand it. And what happened to interest rate? Whoop, whoop. You watch 2 years, 5 years, 10 years, 30 years, all whoop, down. And what happens when interest rates fall in our system where you have record or near record amount of people shorting U.S. Treasury bonds, and you have a decelerating money supply, is lower interest rates cause economic tightening and start to force people to sell stocks to come and cover the Treasury shorts. When they sell stocks, volatility starts to rise. Well, these same people are short volatility. So now they have to sell more stocks to cover their volatility shorts. And the next thing you know, the computer algorithms start selling and whatnot, and you get a whole big mess. And I just thought it was interesting that all of a sudden everyone's like, oh, interest rates are going to go down. No, they should be going down. The Fed is still tightening. Nothing has really changed. All these businesses, all these people who can't afford to borrow right now, for whatever reason, that isn't changing. The Fed isn't easing. They're just waiting for the economy to catch up. Now the question is, will it? Nope. They've done. This deal is over with. I mean, and we can look, is it going to help the global economy? No, because world dollar liquidity is a function of the monetary base plus foreign-owned treasury bonds. Well, the Fed said we're going to stop reducing the monetary base by the end of September. So we still got some time to go. Foreigners are still not buying treasury bonds. In fact, they've been sort of net sellers based on the most current data we have. So global growth isn't going to change either. Is the economy going to continue to decelerate? Yeah, nothing's going to change. So it's kind of really interesting. It's not inflationary. It doesn't mean all the things that we think it means. But what we do know is the Fed is now potentially either they're letting it, because look, the press release said, look, we're going to let things catch up. The real question is, do they know something really bad's coming down the pipe? Do they see something from their contacts globally, domestically, like, nah, this is bad? They're trying to reverse the situation, get people like, hey, it's okay, go out and spend. We're not tightening anymore. Just go out and spend. We'll let you catch up, and then we'll come back and change our mind later. Could be. But I really think that they know something's wrong, and when the Fed starts to back off, that it tells you that you're much closer to the end of the cycle than the beginning. Don't believe me? Wait till the first quarter earnings come out. All right, we've got about 4 minutes to hit the charts, and we'll just look at some of the broad-based stuff and see what's going on here. S&P 500 opened and traded down. Early trading went back up after the Fed announcement and then closed down slightly. The Nasdaq 100 closed higher. Tech stocks have not hit their buyback blackout yet. The Dow was down. Russell 2000 was down. But the key on the S&P 500 is still over this heavy resistance zone, but I'm going to guess that this is not going to hold up here, and the stock prices are going to come down because we're headed into this buyback blackout period. But let's take a look at Treasury yields. Look at 5-year yields. I got to zoom out so you can really see this. Now, I remember it was like, oh no, yields are going higher because it's a topping pattern. It's a topping pattern. Does this look like a topping pattern? Yeah, it's a topping pattern. And it tells us that 5-year yields could get down to under 2, which would be below the federal funds rate. 10-year yields are at 2.5. I don't know exactly where they close because this thing is not exactly accurate, but pretty close to probably 2.53, somewhere right in there. Again, major topping pattern says that these are headed down to 2.3, which would be right just above the federal funds rate. Looks like a 30-year bonds, they close below 3%. Again, and are setting another run at their support level, which if broken will send them down to 2.7 pretty quick. And all that will do is it will tighten financial conditions and really put the Fed in a whirl. Let's take a look at some other things of interest. I really quick want to mention that the Fed said part of their reason, and I knew it. I said this in the fourth quarter. I said, look, oil went down. That's going to change the consumer price index numbers. And they said that. They said, hey, because oil went way down, that is affecting some of our numbers. In fact, the Fed said we need to see oil go up. And I don't think it's going up that soon, despite what the inventory reports said. But anyways, let's take a look at oil and gas producers came up and they tagged their 100-day moving average and held it. Again, this is still resolves to downward as we see the blackout period catch full swing. Let's look at physical gold. It $1 billion got dumped in early trading and then boom, ramped back up here on fears of inflation. But again, there still isn't inflation going on here. And let's see what else we've got. Treasury bonds, 7 to 10 year, boom, big breakout, closed near the high. This is very bullish on strong volume. Let's look at the 20 plus year, boom, broke through resistance. If it holds this, let's take a look at where, again, this is going to go, boom, way up to here. So it's got a lot of room to run. And then the quiet story of ag commodities, little rally here. They let the bears come in, weakness from the bears. And today the bulls fought back. And again, there's massive flooding in Nebraska. It is really bad. And farmers need pretty much ideal conditions to plant, and wet conditions are not good. But anyway, so I just want to give you a quick update on the Fed and what's going on and the big surprises. And over the next couple of days, we'll try to figure out how the market's digesting this. You can't really expect all the answers today, but the Treasury bond market is the place that's telling us what's really going on. So I'm Steve Van Metre. I'll see you Friday. Bye now.